We had the president say over the weekend he wants to see the Fed bring rates down, and it looks like the market doesn't believe that's entirely out of the question. What do you think about the possibility of a Fed cut?
Well, for the time being, this seems to us to be that this would be premature. The data coming out of the U.S. Is quite reassuring. The jobs creations on last Friday was indicated the economy is still very strong. So we expect the Fed to be on pause, frankly, through the end of the year at least. And beyond that, the move could be in either direction. But I think one shouldn't read too much into this market pricing because, clearly, if there were to be a sharp unexpected slowdown, the Fed wouldn't just cut by 25 basis points. He would probably try to do something more major. So what I think this current market pricing reflects is a market that is split as to the direction of the next move, which is frankly consistent with the messaging that the Fed has been communicating.
Good morning to you, Isabelle. Good to see you with us on the European Market Open. You say that the market is confused, maybe. There's different messaging. I mean, looking at inflation, it seems to be delivering quite a bearish signal in terms of the inflation numbers that we've had of late from the United States. I've got a chart here that shows US PCE. Of course, the Fed likes to look at that in white, certainly trending downwards in the latter part of 2018 and into 2019. To shift expectations as they have been priced in the bond market, we need inflation to show up, was the title of one of the stories that I was reading over the weekend on the Bloomberg.
Yeah, that's probably right. But it's a good place for the Fed to be because and they have said our goal is to extend the cycle as much as possible. So growth is looking good. Inflation is not a threat. Now, that doesn't mean they need to do the opposite and go into overdrive and cut interest rates until inflation picks up. They're in a position when they can be patient and they can wait for growth to do its job and gently push inflation up. And we do expect this is going to happen, but at a slow enough pace that right now markets can remain in the configuration they are.
I'm looking at the, we have a great function on the Bloomberg terminal, MIPR, which shows, you can get a world map here and shows you implied policy rates for central banks around the world. And we can see that they're all basically turning negative. Even the Europe over the last 6 months has turned negative. What does this mean for global growth? I mean, we've all talked about the slowdown for a long time. Do you think there could be any kind of, savior in the form of central banks, Isabelle?
Well, I mean, depends what you mean by that. We are in a synchronized, globalized slowdown environment, but that was to be expected. You know, economies are coming back down to their trend growth level from, certainly in the case of the United States, was a rate last year that was much higher. Then we had a slowdown in China, then we had a slowdown in Europe on the back of that, and the central banks have responded and kept monetary policy more accommodating than was expected earlier on. In Europe and in China, we also have a bit of fiscal stimulus. So all of that should help cushion the speed of the slowdown. Having said that, we are definitely in an environment of slowing growth. And that's not something that central banks would necessarily resist too much unless we were getting close to recession territory. But we're not there. And so we expect central banks to keep their current dovishness, but not necessarily see a need to do more as long as growth remains on current trend level.
Isabelle, just to get a sense of whether certain events are on or off the radar, I was interested over the weekend in listening to quite a lot about the threats that Trump has made to shut the border to the south, talking about security being more important than trade over the weekend. Clearly, this is something that would affect that area of the US and Mexico greatly, but the broader implications, is this something that flashes to you as something that might impact the state of the US economy for this year, or is this at the moment just something to watch?
Yeah, so I think it's a good reminder that there are a lot of geopolitical risks, and these risks are primarily to the downside. Markets have become pretty relaxed around these issues because the US-China trade talks have seemed to be going okay. But there are all sorts of other things that can pop up. And another one, so Mexico is one. The relationship with Europe, between the US and Europe, is another one that's been very much off the radar screen. And the events around Mexico over the weekend second, it's a reminder these things could go wrong very quickly, have implications for the trade outlook, have implications for the capex and confidence outlook. And I think that's also why we're seeing this dichotomy between the stock market that seems to be happy about growth prospects and the bond market that seems to be very bearish. And I think this is because of these downside risks that people, understandably and quite rightly, want to hold a lot of duration still in their portfolios in case something goes wrong.